Yeah, hi. It's another good week in stocks last week. We had lots of news coming out on everything from earnings to GDP. Let's start with GDP. The number came in at 2.1%. That is not a bad number. The expectations were actually a lot lower. The expectation was 1.8%, so 2.1% was actually a decent number. That's down from 3.1% in the first quarter, so certainly is showing a slowdown. But with inflation where it is and interest rates where they're going, this is actually not a bad environment to be investing in equities. Certainly in the bond market, that didn't move bond yields at all. So we're in the same environment that we've had for years now, which is just low growth, low inflation, but steady as she goes, so to speak. In terms of international news, we got Boris Johnson that was sworn in as the prime minister. We'll see how he deals with the ongoing Brexit saga. This has been going on for 3 years now. It'll be interesting how he deals with the deadline, the EU deadline, which is October 31st, when the UK would be exiting the European Union. So I'm sure there'll be some volatility around those dates. It'll be interesting to see if he negotiates something or if he just basically takes a hard line and crashes out of the EU, which is the higher probability scenario at this point. An interesting observation is that if you look at the top mutual funds in the second quarter, I looked at a list where basically 14 out of the top 25 mutual funds in the second quarter were actually precious metal or gold related. So it's very interesting that all of a sudden gold is kind of breaking out here after going nowhere for a number of years. And I think that has to do with the fact that every central bank in the world is trying to create an environment for their home currency to basically devalue these currencies. So we're seeing a little bit of an environment where you're seeing competitive currency devaluations. This obviously is something we've seen in history before. In the most extreme sense, we saw this during the Weimar Republic, which was the period right after the First World War and before the Second World War. This was a period where you had lots of populism and nationalism and protectionism and tariffs, and that led to obviously slowing of economic activity, but also then the need for these currencies to make themselves more attractive, to make their exports more attractive. So typically when that occurs, you do see precious metals like gold and so forth going up. So we're warming up to the idea to add gold exposure to some of our portfolios, in a sense as a hedge, but I think it's quite timely to have some of that exposure in your portfolios. On the earnings front, so we had lots of companies that gave out their earnings. Facebook was very interesting, very strong numbers out of Facebook. User growth was even up, which, if you think about all the scrutiny that Facebook is going through with the government and privacy issues and all that, that even their user metrics were actually more positive. The part where they guided down was on advertising revenues going forward. They're seeing their advertising revenues decelerate, and I think that's in line with what we're seeing in the broader economy, but it just echoes the weaker economic outlook. Amazon also had very strong revenue numbers, but they missed on earnings per share, and that's because Amazon is fighting this war in the retail sector, where they're basically saying we can ship next day and we're going to pay the price for that. And because they have so much scale and efficiency, they're basically saying we can outcompete anybody out there by forcing the entire industry from competitors like Walmart or Target or whoever to ship next day. So they're biting the bullet here and basically eating a much higher cost near term to get to this next day shipping. But we're not worried about Amazon getting this wrong. Amazon just has so much scale and is really the innovator in the what we call the omni-channel, which is where you have this convergence of e-commerce and bricks and mortar. So they will continue to take market share from everybody else. I mean, Amazon's revenue growth were 20%, and that was an increase over the previous quarters, and the previous quarters was below 20%. So on that front, they're doing very well. Other companies that we follow closely, Thermo Fisher, Boston Scientific, these are two healthcare, very diversified healthcare stocks, very good numbers. These are not cheap stocks anymore, but they've continued to grow into their valuation and their higher PE ratios. The big outperformers in terms of performance last week were Starbucks. Starbucks is completely back on track. They're the king of coffee again. Their same-store sales are back to 6% globally. That's an extraordinary high number for, if you think about, for a restaurant. The expectation for same-store sales for Starbucks were 4%. So they're, the U.S., the Americas, and China, Asia Pacific are the two growth engines of their store base. In the Americas, they opened about 641 stores. In China, Asia Pacific, they opened about 1,000 stores. I mean, that's amazing new store growth. On top of that, they had 3% transaction growth and 3% price increases. So here's an example of what we call a bulldog, which is a company that has incredible pricing power. So, if you're one of these people that stands in line or uses their app every morning to get their coffee from Starbucks, you're not going to think twice if they raise your coffee prices by 3% or anything like that. That's just an extraordinary business model. The other company that had blowout numbers was Alphabet, also known as Google. Google beat revenues handily, and their earnings per share were a couple of dollars ahead of the consensus. They reported $14.21 versus a consensus of $11.19. And the main driver of Alphabet's growth was actually their cloud business. There was a good article actually in Barron's on the cloud space, and there was basically some cautionary tones there saying that valuations are getting kind of lofty amongst the cloud players. I mean, the cloud companies are software companies are Microsoft, AWS, which is part of Amazon, and Google is the other one. That's the big one. There are other companies like Salesforce and Adobe that certainly operate in the cloud, but these are the big ones. And the notion is that this is somewhat saturated. We don't believe that. We think there's still a lot of runway in cloud computing, and we see that in Alphabet's numbers. I mean, the cloud business at Alphabet is now $8 billion of their business. It's the third largest business segment of Alphabet and continues to grow incredibly fast. So on top of that, Alphabet announced a $25 billion share buyback, which shows you how much cash they're generating out of those earnings. So a great week for earnings, a so-so week for GDP, but this week we're now obviously anticipating the interest rate cut. We'll see what the Fed has to say about that, and there are many more earnings coming out this week, so we'll get a much clearer picture where our companies are and where the economy is going. That said, we'll see you next week. Take care.